Today on the Joseph Carlson Show, it is again time for the 13F filings. We have from the super investors, the biggest investors in the world, managing the most money in the world. They're now giving their report card. They're showing what they bought, what they sold, and their current portfolio. So this gives us an opportunity to see a unique insight and look into the minds of what's going on with the biggest investors and in some cases, the best investors in the world. In this case, we have a full roster here. We have Chris Hohn of TCI Fund Management. Chris Hohn is a superb investor that invests only in monopolistic dominant companies, high margin ones that he considers indestructible. And his portfolio so far has been indestructible. So we're going to be looking at what changes he's made. We also have Terry Smith. Of course, we've seen some commentary from him. We'll be looking at his trades. We have Polen Capital. Polen Capital is a management firm that manages $37 billion. And I really like their portfolio, but I'm a bit biased. It looks quite similar to mine in a lot of ways. So I'll be looking at Polen Capital's. Then, of course, we have Josh Tarasoff. He's more of a small-time investor, only managing $300 million. And then we have Bill Ackman. We know that he just bought Uber Technologies as a major concentrated position, and we have the write-up. We're going to be looking at his thesis on Uber Technologies, and I'll be reviewing it. And then we have Brian Lawrence, who has a big concentrated position into Interactive Brokers. And we're going to be doing a little bit of a look of why some super investors are betting so heavily on that company. Now we're going to start things off with a look at Chris Hohn's portfolio. And if you don't know Chris Hohn, I've covered him before in some detail, but he's a guy that runs a portfolio that is extremely strong. And it was built on the premise of being indestructible. See, when he started his fund way back in like 2005, he went through the 2007 recession and financial crisis. At the time, he held many banks and financial institutions that just got crushed. So he went through all of that, and then he had to repair his reputation. He had to repair the performance of his fund, and he did so by vowing to never again buy weak companies. He defined weak companies as ones that their business model was susceptible to different economic environments. Instead, he focused on companies that had impenetrable business models, ones that were all-weather, ones that worked in any market condition. He focused his portfolio solely on compounding machines, monopolistic companies, and it's a highly concentrated portfolio. After the 2007 financial crisis, he had a great bounce back, changing his portfolio, and then he continued on year after year after year of incredible performance. He eventually regained his reputation, and in 2023, he was one of, I believe, if not the best performing large hedge fund. In fact, the Wall Street Journal wrote about Chris Hohn saying that Chris Hohn's TCI tops hedge fund rankings with $12.9 billion haul for 2023. So Chris Hohn had a great 2023, topping the list of hedge fund managers. Then in 2024, his performance underwhelmed. Last year, 2024, Chris Hohn only had 15% gains, while the S&P 500 surged 25%. So this is meaningful underperformance. And if we look at his portfolio composition here, we have his largest holdings at the top to the smallest ones. And you'll notice across the board, this is a dominant, concentrated, monopolistic portfolio. He has the clear monopoly companies like Moody's and S&P Global. Now, if we look at the trades that he made and we organize it by the biggest changes to his portfolio, the biggest change he made in Q4 of 2024 was adding 16% to his Microsoft position, and he sold a little bit of Canadian National Railway. But this isn't a significant change. Overall, he had a 2% portfolio weighting to Microsoft, and then sold down 1.4% of CNI. Very minor changes. Overall, this is the theme you see with these super investors that have these very concentrated, high-quality portfolios. The purpose of this is to not have a lot of trading, to make a couple good decisions and keep those decisions. So even though Chris Hohn will have stretches of time of a little bit of underperformance, he'll also have great stretches of time of outperformance. And what will determine his long-term performance is the intrinsic value growth of his portfolio. This portfolio, I believe, will grow intrinsically at a much faster pace than the rest of the market. So on a 5-year and 10-year basis, I think he's going to outperform. Next, we have Terry Smith, who runs Fundsmith, and he has for over a decade. Terry Smith is highly competitive. He's been called the Warren Buffett of Britain. He's a guy that is very vocal about his positions, and he gives big shareholder meetings, and his performance so far has been all right. Now, when we look over Fundsmith and the returns, There's a couple little critiques I have. I know, I don't want to be too critical, but I feel like this is worth pointing out. For example, when we look at the performance of Fundsmith in the table that he shows, one of the things he does is he compares his portfolio. We have Fundsmith right here, and he compares that against equities. Now, it doesn't say the S&P 500, it just says equities. When you look further, the equities that he's comparing it to is the MSCI World Index. Now, just to be a little bit of a critical here, a little critique, the equities or the World Index has underperformed the S&P 500. So he's basically comparing his performance to an index that is not performing as good as the S&P 500, while most of the companies that he invests in are the S&P 500. So he's investing in a very S&P 500-esque portfolio, but he's comparing his portfolio to the world index. And I think he does that to give himself a little bit of an advantage, because had he compared himself against the S&P 500 instead, the S&P 500 is much closer. It's around 14.5%. So his performance differentiation between the S&P 500 and his portfolio is much smaller than this one. So I just have to point that out. When I compare my performance, when I look at what I'm doing, I compare it directly against the S&P 500, and I've done that since 2022. When I was managing over $100,000, we have the S&P 500, the Story Fund, and the Passive Income Portfolio, which are my two portfolios. And I also compared that against the QQQ as well, which since 2022 has had very similar performance. But that's just a minor critique, and it's something that a lot of hedge funds do to try to make their performance look relatively better. By comparing to a weaker benchmark than the S&P 500 or the QQQ, they give themselves a bigger advantage. So just keep that in mind when you're looking at these comparison tables. Now, overall, 15% annualized performance for Terry Smith is still really strong. When I look at his portfolio, I don't see that many changes. In fact, if we look at the activity, we bring this up and we filter it by the changes to the portfolio, the biggest change here was selling all of his Apple position. So he's completely out of Apple. Now, if you followed me, this will come as no surprise. I've also sold 95% of my Apple position. If we go into the passive income portfolio right now, this is my main one, and we look at the tech category, I have $6,000 of Apple, which is around 0.5% holding. And the reason why is because I'm still just keeping it as a watcher position. I want to keep an eye on it. I want to have it be part of my presence of mind, but I don't want it to be a meaningful position right now. So I've reduced my position down to just a watcher position, and Terry Smith has completely eliminated his Apple position. And I believe I know the reason why. If you look at a company like Apple, it's always the case where we try to do qualitative analysis. We look at the qualities of the company, the moat, the leadership, the product development, all of that great stuff. But ultimately, all that research boils down to a couple key metrics. The big questions for investors are, what is the company currently trading at, the valuation or forward multiple of the company, and how much growth is expected in the future. If you have a company that trades at a high multiple, like Apple, a very high PE ratio, but you're also assessing that it's going to have low earnings per share growth, that's a difficult equation. For each company that I own, I want either high multiples and high growth or low multiples and high growth. I don't want any companies that have low growth expectations. Now, of course, Apple could surprise us. They've done it before. And Tim Cook recently tweeted something that was a little bit out of left field. He tweeted, "Get ready to meet the newest member of the family. Wednesday, February 19th. So next Wednesday, we're going to see the new member of the Apple family. We don't have any rumors of what this is. Even Gurman, the guy that leaks all the Apple stuff, doesn't know what this is. It's a spherical thing here. And the Apple logo, like it's changing. It's metallic. Interesting. Maybe this will get me back in the company. Maybe it's something so groundbreaking and shocking that we're back on the Apple train. It was also interesting that Elon Musk retweeted this. Now, a lot of people are saying that means Apple's partnering with Tesla. I don't think that's the case. I think Elon Musk is retweeting it because Apple started advertising on X again, and he was happy about that. But we'll have to wait and see. That's why I have it as a watcher position. I could enter back in if I think there's going to be some game-changing product. But right now, this is just a bit ominous. We have no clue what this really is. So I understand the move to get rid of Apple. I don't think that's a bad trade. That money can be better used elsewhere. But Terry Smith goes on to trade out of a lot of high quality companies. He sold out of a little bit out of Microsoft, Visa, Meta, ADP, Fortinet, all these different companies. And he only bought a little bit of MedPace and Doximity, two companies that I'm not that familiar with. Overall, he is a net seller this quarter. And typically what that means is that he's had redemptions, meaning that he runs this fund and some people wanted to pull their money out for one reason or another. So he had to raise capital and sell out of positions. So a lot of these trades just seem like standard redemptions, just trimming some shares to raise some capital. The only one that really stands out fully is a complete Apple sell, and I think for decent reason. But Terry Smith is patient, he's methodical. I believe he has a decent chance of bouncing back over the next year or so. And I think that he has really good companies in his portfolio. The top position, which is over 11%, is Meta, which I really like. I've been so impressed by what Meta has done. It's actually blown me away what they've been able to accomplish. One of the most shocking things from the last earnings season was that Meta outgrew Amazon in ads. Of course, Meta is a complete advertising business, but just consider that. Meta, at the scale that they are with their business, $164 billion, outgrew Amazon in advertising. Amazon's relatively new in it. Amazon just launched ads in Amazon Prime Video. Amazon has the highly targeted ads as sponsored listings on their marketplace. How did Meta outgrow them in revenue with their advertising business? I believe the only way possible for Meta to optimize these ads the way that they are is through incredible usage of artificial intelligence. So I believe Meta is fully taking advantage of AI, and it's been incredible to see the performance of this company. So overall, I approve of Terry Smith's trades. I like the Apple trim. I like the top holdings. I think he's on a good track. Now, one that I've started covering more recently is Polen Capital Management, and I've been really impressed by this management firm. It's not just one person managing it like Warren Buffett. It's a whole group of people, but they segment it by category. And what we're looking at here is the focused growth strategy. It's the most similar to our style of investing, and Polen Capital Management manages $37 billion. So huge fund. Just massive. When you have this amount of money, it's incredible to see the changes they're making because it's such a significant amount of capital. Now, when we look at the list, we have a lot of familiar names, and this is why I like looking at what they're doing. We have companies like Amazon, Microsoft, Google, Visa. A lot of people say, oh, this is cheating. They're just investing in the top companies. I think every good fund manager should do this. If you're trying to circumvent big tech, and also have positive returns that beat the market, good luck. It's nearly impossible. So by having some of the big tech companies as an anchor to the portfolio, it gives you such a great chance of outperforming, especially if you trim off a lot of the other companies that cyclically don't do as well. So when I look at this, I see the largest position here actually being quite different than the index, which is Amazon. Amazon is not 12% of the S&P 500. It's not 12% of the QQQ. So they're overweight Amazon by a large degree. Now, when we look at their trades, it's true if we filter this by the biggest trade that they trimmed their Amazon position by around 1/4. So they sold off 1/4 of their Amazon position last quarter. When you're looking at this, you can get the impression that that means they believe that Amazon's becoming overvalued. They're no longer as bullish on Amazon. They're trying to reduce the position and sell out. And that is the entirely wrong conclusion. I went ahead and looked up their investment letters that they give out to their shareholders just to see their thoughts on Amazon. And this is their most recent commentary on their portfolio and trades. This is just a month ago. Consistent with our thesis, Amazon has continued to see operating margins expand, hitting 11% in the most recent quarter, after bottoming around 2% at the end of 2022. This March higher in margin stems from a mix shift towards faster growing, higher margin segments of Amazon Web Services and advertising, combined with better fulfillment efficiency in the e-commerce business following significant investments in recent years. So what do they outline as the first thing of their thesis in Amazon? That over time, Amazon becomes a higher margin business. For example, if we look at Amazon in Qualtrim here, we can see this playing out. I'll show you it directly. Right here, we have the revenue by segment. If we filter this by the lowest margin portions of Amazon and only look at the low margin stuff, this is what it looks like. Growth is 6% year over year, 6.5%. So the low margin stuff, where they sell their own batteries and toilet paper, the really low margin products, Amazon's barely growing with that stuff. Then we filter the opposite. Let's cross out all the low margin stuff and let's check in all the high margin stuff. And we can see the growth rate of this. It is 15% year over year. So all the great parts of the business are growing roughly 3 times as fast as the low margin portions. That's a good thing for the company. It means that the shift mix of the company overall is becoming higher quality. Now they continue on here, noting the impact of artificial intelligence in Amazon's business. Further, speaking to its runway ahead, CEO Andy Jassy noted that the company's AI business is a multi-billion-dollar business growing triple digits, 3 times faster than AWS did itself at the same stage in its evolution. So obviously artificial intelligence is this huge positive for AWS, but one of the things they leave out here, which again has been my thesis for Amazon all along, is that it's an underrated AI company. Not just AWS, but the entire company. Artificial intelligence is going to help out with advertising in the same way it did for Meta. It's going to help out in robotics in their facilities, making them more efficient. It's going to help out with understanding their logistics network and making it more dynamic and, again, efficient. All across the business, every layer of the business. Amazon says themselves that they're implementing AI in over 1,000 areas of their business. So I think it will completely transform it and make this monstrously huge, low margin business a little bit higher margin. If that happens, the operating leverage is immense. They say while we trimmed our position during the quarter, Amazon remains our largest position, as we expect approximately 20% earnings growth over the next 5 years, driven by a mix of solid organic revenue growth and continued margin expansion. So does it sound like they're now bearish on Amazon and they're wanting to exit the position? No, this is just a massive firm that has a trading layer on top of their core positions. When one of them has a little bit of a positive momentum, they take some gains there and move it to a different position, and they're constantly doing that. So Polen Capital is like 2 different types of firms. One of them is their core positions that they invest in and they have for a long period of time. And then they have another layer which takes some of the gains of some positions and moves them to others as they try to balance out and make extra gains with trading. I think overall, their Amazon sell is not indicative of their bearishness of the company or anything of the sort. In terms of what they purchased, they added a little bit to Oracle, they bought into a CoStar position, and they added to Eli Lilly. Now again, overall looking at this portfolio, the reason that I like it is I see a lot of familiar names there. I'm very familiar with a lot of these companies. I like that they're willing to invest in big tech. I think it's a mistake when hedge funds try to avoid this. It's only to your own demise. But I also like that they're focused on the high quality companies. They have Visa, MasterCard, the duopoly there. Another position that I really like seeing in their portfolio is Shopify. This is one that I really, really like. I think Shopify will make it into the passive income portfolio at some point in the future. Shopify is another company that they trimmed, but their commentary shows that they're still very bullish on it. Shopify, a leading e-commerce platform that allows businesses of all sizes to create, customize, and manage online stores, is a new addition to the portfolio in the second quarter. So they just bought into this one. Shopify had this massive surge upwards. Now they're taking out a slight bit of gains. See, they're just trading on top of these core positions. It represents a top contributor to relative performance. The company is firing on all cylinders, and the stock responded, up 21% on the back of its latest strong set of results. Gross merchandise value growth accelerated despite a tough year-over-year comparison. The growth of Shopify is incredible. If we bring up this one, you can really see the revenue growth. It is insane. Look at the Shopify revenue growth just this last quarter. I had to double check it. I thought it was incorrect, but this is correct. That's what it looks like. The last quarter was 31% revenue growth over the previous year. So massive revenue growth. When we look at this at a trailing basis, this is what it looks like. An insanely fast growing company, one that's becoming highly profitable. The free cash flow is accelerating. The stock-based comp is going down. Everything looks great for this company. On top of that, Shopify is not just some small company that hosts websites. They have Shopify Capital, where they're now in the lending game, partnered with banks, providing capital to all these small businesses. And they have unique ways of collecting back, and they have a lot of other things they're doing. Other companies that I like in the portfolio, ServiceNow, we have some Apple, We have Netflix. Obviously, I'm still very bullish on Netflix, so I like seeing that one. We have a lot of the high quality basket names: Thermo Fisher Scientific, Accenture, MSCI. These are all incredibly powerful, wide moat companies. We have Workday, Airbnb. A lot of investors go with Airbnb. My personal opinion is, even though I think Airbnb might have a more interesting story, I think that Booking Holdings will have superior returns because of the capital composition of the company, the marketplace position. Booking has a really strong method of making money right now, and I think it's going to have better returns, but we'll see. I also think that Airbnb is a very high quality company. Overall, a very strong portfolio, and I wouldn't read too much into the minor changes they're doing with the trades. I think the commentary explains it better. Now, next up we have Josh Tarasoff, who made his name with his thesis on Amazon way back in 2006. He made this entire investor presentation on Amazon, saying how it will compound and grow at a massive size. That thesis obviously played out, and since then, Amazon has been the key figure in his portfolio. So he's really made his business, his name, his reputation, all based on that Amazon thesis. Now, Josh Tarasoff manages a small amount of money comparatively to these other hedge fund managers. They're managing $20+ billion. He's only managing $331 million. So still a lot of money, but not a lot in the game of hedge fund management. When I look at his portfolio, he has a concentrated portfolio, only 8 positions, with again, Amazon being the largest position by far. So we have a lot of selling going on and no buying. And there's one of two things that this could be. One is that he's just raising cash because he thinks there's going to be some big opportunity or the market's overheated. I think that's unlikely. Number 2 is that he just has redemptions. He has people pulling out money from his fund, and he hasn't been in the game of raising more capital. I think that's far more likely. Out of the companies that he's selling, he sold Microsoft and Trupanion and Tesla. These 3 were the 3 top sells. Microsoft, he completely eliminated his position. If I had to guess, the reason he sold Microsoft, it's just valuation. The company has done so well, the valuation has been so high that I think future expected returns are slightly lower. So he's probably viewing it as a decent time to trim that one. And he probably knows that there's better opportunities to enter into Microsoft in the future. So even though I'm a Microsoft shareholder, I still hold the company. I don't plan on selling it. I don't disagree with this sell. I think if you're going to trim one of your companies, Microsoft isn't the worst one to trim right now just because it's so fully valued. In terms of his portfolio composition, I'd love to see his investment letters or his reasoning behind it. I'd love for him to do some podcast appearances and explain his thought process, because from what I see, it's a bit messy. A lot of these companies don't really coincide with each other. He has Tesla in the portfolio with Berkshire Hathaway. So he has some really stodgy, cash flow positive companies, and then some that are more based on future narrative and evolutions and step changes in the future. It seems like a really mixed bag of holdings without any type of solidified or streamlined investing philosophy. Now, next up, we have Bill Ackman. Now, as of the recording of this video, we don't have his 13F filing, so I can't see exactly what he sold and bought, but don't worry. We're gonna have a part 2 to this on Monday. So all the super investors that I don't cover in this video, just make sure you subscribe to the channel, and we'll have another video out Monday going over even more of them, like Dev Kantasaria, Bill Ackman, many others. So make sure you're subscribed to the channel and you can see that one. But the reason that I bring up Bill Ackman today is because he already released some information of one of the major buys that he did, and that is Uber. Uber is also a company that I've been covering for quite consistently for a couple months now. So this is one that I was very interested in. Now, Bill Ackman always does this thing where every time he buys a new company, he has an investor presentation where he tries to explain why he bought the company, why he believes he's going to make a lot of money in it. So let's go ahead and read his thoughts on the company, his bullish thesis. Our new investment into Uber Technologies. It's the world leading rideshare, mobility, and delivery Uber Eats marketplace. Now, a little caveat there, specifically with food, DoorDash is bigger in market share than Uber Eats, but Uber Eats has huge opportunity to grow and take market share from DoorDash. You can hear Dara, the CEO of Uber, talk about this. DoorDash capitalized on the more urban, less dense populations, and that was a massive market. So Uber really missed that marketplace, and now they're trying to compete with it. They believe that they can grow continually in those markets for the next 3 years. Uber's business model has a strong network effect that reinforces supply and demand growth. 170 million monthly active and 8 million drivers across 70 countries. Large demand increases driver utilization. Large driver supply decreases wait time and user prices. Gross bookings, the trip value of 160 billion is split between mobility and delivery. Fast-growing international business accounts for more than half of bookings. Industry-leading management led by Dara. He's a great CEO. I really like him. Management target implies 30% annual EPS growth over the next several years, driven by mid to high teens revenue growth, robust margin expansion, and share repurchases. This part of this slide is the core of the thesis. You have projections internally from management that they've also shared, expecting 30% annual EPS growth. Now, when we combine that with the valuation of the company, remember, companies are ultimately a mixture of the earnings per share growth and the PE multiple, or the free cash flow yield and the free cash flow per share growth. So you're looking at the mixture and the right combination of that. With Uber, you have a company that is only trading at a 32 forward PE ratio with 30% expected EPS growth, meaning just on 2026's earnings, it's trading at a 23. So this company will get really cheap really fast as they continue to grow. All of this, I think people can agree on. Uber is going to grow over the next couple of years, but I don't think this really addresses the heart of the concern from investors, which is, of course, the potential for disruption. With every company, there's kind of two different parts to it. There's what they're doing in the short and medium term, how fast they're going to grow over next year's earnings and margin expansion. And then there's the terminal value of the company. Basically, how long is the company going to grow for? How stable is the business? How predictable is it? With a company like Costco, even though it's expensive today, investors have a very solid reason to believe it's going to be around for 20, 30, 40 years, still kicking out cash at that point in time. With Uber, that's a bigger question because there's massive dynamic changes happening to vehicles, which is the heart of their business. So all the future margin expansion and earnings growth, I think, is great. It's good information to have, but the heart of the question is right here. The long-term risk to Uber from AVs, which he says is limited. AV companies likely to partner with Uber over time due to its strong value proposition. So they're firmly in the camp that they believe there's going to be partnerships and collaboration rather than disruption. Uber's 20% per ride take rate is low relative to the value it provides, which maximizes vehicle utilization and driver revenues. Attempting to replicate Uber's capability versus partnering is economically irrational. Demand aggregation of 170 million customers and ride matching technology significantly increases utilization and revenue. Scaled network provides driver routing, pricing functions, insurance, regulatory support, customer support, fleet management services. So you can try to say that Uber is just an app. That's how a lot of people try to downplay what Uber does, but they do way more. It's a company that has a lot of on-the-ground operations and know-how and a highly geographically diverse business. Uber already has 14 AV partners across mobility, delivery, and freight, which are likely to expand over time. Waymo is by far the one in the lead, and I think that one is determining whether or not it's best to partner with Uber or not. Waymo's in the process of testing out different business models. So I think it will be really indicative of whether or not Waymo partners with Uber with everything, or whether they believe it's better to go their own route. Uber is trying to diversify away from the risk of AVs. For example, delivery is 50% of bookings and is unlikely to be affected by AVs due to courier involvement. International mobility is 50% of bookings, and large-scale AV introduction unlikely due to underdeveloped markets with lower per-trip monetization. For example, in places like Brazil and India, you're not going to have robo-taxi networks from Tesla anytime soon. And in places like Europe, you also have stringent regulations that make robo-taxi even more difficult there as well. Capital-intensive road infrastructure, car charging, and parking build-out required for large-scale AV introduction. Even if the safety issue was no problem at all, the capital-intensive nature of building out a robo-taxi fleet, managing it, and charging it is very difficult. So there's multiple hurdles and things that need to be accomplished to become a real competitor to Uber. And then finally, the large-scale AV introduction would likely significantly expand the overall rideshare market. Rideshare penetration is less than 1% of total annual miles driven to relatively high cost per trip and limited driver supply. So right now, ride sharing is still a tiny fraction of overall transportation. Potential to both increase supply and significantly decrease cost per mile, leading to significant market growth. So Bill Ackman's under the impression that even if AV companies are successful in scaling their product, it's only going to grow the pie for all involved. It's not going to take away directly from Uber. Now, after writing this, of course, it got a lot of investors excited. Uber stock jumped up around 10%. Now it's trading at a price around $79. So it's up around $80 per share. It's still relatively cheap. If you believe in the thesis of Uber of being this long-term aggregator, I still think even now is a fantastic time to get into the company. For me, I think that Uber is a great bet overall, but I have a lot of great companies already in my portfolio, so I'm still debating of whether or not I need Uber. Now, we're going to be looking at Bill Ackman's full portfolio again in the next video. Now, next we get to the portfolio of Brian Lawrence of Oak Cliff Capital. This is a smaller portfolio comparatively. It's a $200 million portfolio. But it's interesting to see the levels of concentration into only a couple names in his portfolio. Now, I couldn't find anything directly from Brian Lawrence about Interactive Brokers, so I searched around for different hedge funds that maybe gave commentary on that same position. Knowing that it wouldn't represent Brian Lawrence, it's putting words in his mouth, so I don't want to make it sound like he's saying this, but I wanted to find other hedge funds and why they're also buying this company. And another hedge fund that also has a huge concentration into Interactive Brokers is Hohn Group. Hohn Group does write about their holdings, and they've also had stellar performance, performing 19% returns for the past decade. 19% beats Terry Smith, it beats the QQQ, it beats the S&P 500, so they've done a fantastic job, and one of their largest positions is Interactive Brokers, which they give an update on right here. Interactive Brokers is a highly automated global security firm that specializes in routing orders and processing trades in securities, futures, foreign exchange instruments, bonds, and mutual funds on more than 150 electronic exchanges and market centers around the world. So this company does a lot. It does a lot with automation. Interactive Broker custodies and services account for hedge to mutual funds, registered investment advisors, proprietary trading groups, introducing brokers and individual investors. Already the description of this company is much different than what I thought. I thought it was literally just a brokerage, and here it is more like an automated trading platform. More than 2/3 of Interactive Brokers' customers are based in Europe and Asia, and an even greater share of its new customers come from those regions. That makes sense. I have a lot of people in my community that use Interactive Brokers, but almost all of them are from Europe. They conclude with this company that notwithstanding Interactive Brokers' strong performance in 2024, the stock still offers attractive prospective returns. Although the normalization of monetary policy in the US and elsewhere will be modest headwind for the earnings growth in the immediate future, Interactive Brokers should be able to grow its pre-tax income in the high teens annualized rate over time. Interactive Brokers also pays a modest annual dividend that may periodically ratchet up over time. And while Interactive Brokers' capitalization rate has improved from where it was at the beginning of 2024, the change in their capitalization rate over time should still add to the total return of the stock over the coming years. So Hohn Group is still bullish on this company. And when we look at the super investor Brian Lawrence, they're still very bullish as well, having it still as 27% of their portfolio. Now again, they're a different fund, so maybe they have a different investing thesis, but I think this helps give at least a little bit of explanation of why they could be bullish on this company. There's likely a lot of crossover between the theses. Now that's all the super investors for today, but we still have many to cover in the next episode of the Super Investors. We'll be going over Bill Ackman, Dev Kantesaria, Michael Burry, and many others. So make sure you subscribe to the channel, and I'll see you on Monday.